I am C. Radhika Singhal. So this is the last topic of our syllabi, mainly theoretical for an examination point of view. And generally, as per the past trend examination, one question is there from this topic. So we are going to understand in this topic that what exactly the meaning of project planning is there and what are the different sources of finance, like how project has been planned before taking in project decision. So when I'm talking about project decision, like we study capital budgeting in our last session, where a decision has been taken to optimize the profits in an organization by reducing the cost and taking an optimal project when there are two options available. Likewise, a project decision has been taken just to optimize the return from the project in which the company is investing. So for taking that decision, the management first has to plan that how we are going to accomplish our goals. So for that, a plan has been created in which we define that these are our end products which will be performed and this is how we are going to achieve our goal. So in a project planning, we used to define that what are the major tasks to be performed, how much resources are required in performing that task, what time will be taken. So all these will create a framework that this is how we are going to start. These are the activities which are going to be performed and this is the end result which we will achieve after that time. So in this we can evaluate that how much cost will be there, how much resources do we need, how much time consuming it is. So all these will give an idea that how the project is going to be laid off. Right. So to write down that what exactly do we need and to explain it, we create a project plan. So to explain that project plan is, you can say, is a formal and an approved document, right? So a project plan, you can say it is the one which is being approved by the top organization. So now a project plan has been created, a framework has been created at what they want to achieve and how they are going to achieve it. So a project report is created before making any investment just to evaluate that whether that investment is fruitful or not. So a project report helps to evaluate, or you can say it's a pre-investment study of the investment proposal, which includes all the investigation from economic point of view, from social management point of view, from technical point of view, right? So you are going to prepare that project report and then this project report is submitted to the investors. Let's say to the financial institution for getting the funds. So what a financial institution will do with that project report? He'll study in the project report what is the project profile. So a project profile is studied to know whether it is reliable and it could be formulated. So in a project profile, the things which is taken into consideration is whether the project report prepared by the corporate is a type of approved project or not. And also, the project is as per the prescribed standards of the financial institution or not. So this is just a brief study of the project, that what exactly the project is, what is the motive of that project. The next is to evaluate the promoter's capacity and the competence. So promoter capacity and competence can be examined with reference to their management background. So in this, the trait of the entrepreneur, his business or industrial experience, whatever his past performance is there, his creditworthiness, his credibility, his integrity, his reputation in the market, and other competencies in the market, the legal aspects, all these things are studied before appraising a project. And the third one is the viability study. So viability study means actually testing whether the project is technically viable, financially viable, economic appraisal, social distribution appraisal. So by the word appraisal means to critically examine with a focus of attention on specific aspects, areas of operations and target goals to ensure that whatever performance that you're expecting, it is actually achieving the proposed goals or not. So to confirm them, it is being appraised. So technical aspect means actually evaluating that whatever the project has been created, whether it is suitable. So if it is an Indian project, so it is suitable for whether in the Indian condition. For example, you're creating a car which is very good. However, such roads are not there in the India. So though that project is very sound, but is not technically viable because it is not made for Indian conditions. So if you're bringing such project in India, it will definitely fail. Another example that you can take is like, for example, you're setting up some industry which requires a certain set of temperature, and that temperature is not there in India. It's somewhere, or you can say a very cold temperature is required, and such temperature could not be created. So again, that project might be very fruitful, might be very favorable for the organization, for the economy, but again, there is a technical unfeasibility. So in the technical aspects, whatever the plant layout is there, which machinery, which equipment to be used, whether the raw material required is available or not, and the other inputs, they all are taken into consideration. The next is to test the financial aspects. Let's say that you bring one project, but that project you do not have that funds, or it requires a lot of funds which cannot be arranged. So again, the end result is not taken. It is seen that whether that funds could be available, whether the finance could be managed. So the primary aim of this financial aspect is to determine whether the project it satisfies the investment criteria of, or it affects that how much profitability could be generated, and also whether the project has the capability that it can give the investor their expected rate of return. So all these things are also considered. The third one is economic appraisal. Economic appraisal means examining the project from economy point of view. So whether that project which is into consideration, whether that will improve the economic welfare of the country or not. So generally this is like for any government project. Might be that project is not so much profitable, but it is very economically good for that country. So this is one aspect also. The other aspects like environmental aspects, where an environmental analysis have been done that whether this project is not actually harming our environment. And nowadays this has become a very important in India also, because there are certain organizations which give a NOC certificate before running of any industry, which actually gives a certificate that yes, that particular industry which is being set up is not affecting the environment badly. So there is certain banks and financial institutions which are taking certificates from the environmental specialist or certain organizations provide such certificates to ensure that whatever project they are funding is environmental friendly. So all these types of viability tests are done before appraising any project. Now, though you have created all, like a plan has been created, the next, whatever project appraisal is taken, you have to also analyze that how you are going to take that fund. There are various sources of funds available. The easiest one is to take a loan from any financial institution. For that, you have to submit a project report, and if that financial institutions see whether after doing all those study, whether that loan could be passed or not, a loan is approved. The other sources of finance are like lease finance. So in lease finance, there are two parties. One is called as lessor and the other is called as lessee. So in a lease finance, the lessor owns the asset and it gives that asset to the lessee against some periodic lease payments. But there are two types of leases. One is operating lease and the other is finance lease. Finance lease, you can also call it as capital lease. So what happened in finance lease, whatever the term is there for a finance lease, that is almost equal to the economic life of an asset. And that is being amortized within the, you can say more or less whatever life of the asset is there, generally it is being lent for that period. The lessee is responsible for the maintenance, insurance and other expenses. And there is certain lock-in period for some time. So in that case, the lessee cannot cancel the lease agreement. The other type of lease is operating lease. So any lease other than the finance lease is called as operating lease. Operating lease is for a very short term as compared to the economic life of that asset. So in this, generally, the maintenance and insurance expenses is not on a lessee, which is there in the finance lease, but generally on lessor. A lessor usually provide a know-how. So for example, you need a projector You want that projector, but you do not know how to operate it. So lessor will let you know that how to use that projector. So if that maintenance and insurance expense is on the lessor, it is called as wet lease. But when the lessee bears the maintenance and insurance expense, it is called as dry lease. Now there's another one, leveraged lease. So leveraged lease is, you already knew what is finance lease, right? So in this finance lease, all the risk and reward are generally transferred to the lessee, right? But what happened when the lessor do not actually own the asset? What he do that to buy that asset, he used or he borrowed the funds to purchase that asset. So the asset which is given by the lessor to the lessee, that asset is also purchased from the borrowed funds. So there are three parties now: lessor, lessee and a lender. The lender is the one who's giving the funds to borrow that asset. Lessor is the one who owns that asset, and lessee is the one who's actually using the asset. This type of lease is called as leveraged lease. The other source of finance is hire purchase. So in an hire purchase, the asset is purchased by the hirer. So there are two parties, hiree and hirer. To explain more, what happened when you want to buy a car? So you are the owner of the car, you buy that car, but you do not have that funds. So to finance that car, you take certain loan amount from bank. The car actually is in the name of the bank. You are not owing that because you have not yet provided the funds. It's the bank which has paid the vendor, the car owner, on your behalf. So you have start paying certain installment amount. So it's the hiree who purchased the asset and you are paying to get certain installment amount. When you pay the last installment amount, that car will come into your name. So in a hire purchase, after paying the last installment, the hiree becomes the owner. And what happened in the lease agreement? Even if he pays the last installment, the owner is the lessor. So in this, the hiree just make an initial deposit and purchase the asset, but he gets the right over that asset or becomes the owner after paying the last installment amount. The next source of finance is through venture capital. Well, this source is generally used by the startup organization. Venture capitalists are the one who provides funds to the new organization, because what happens when there's a startup? He cannot take a bank loan because they do not have any such record. They cannot attract the investors. So based on their plans and to evaluate with whether that how their plans will go, whether it will be successful or not, depending on the entrepreneurial skill, their innovativeness, their future, there are certain organizations which provide funds to their such type of businesses. You can say startup organizations. Now, you are also thinking that how venture capital has the funds. What they do, they pool investors' cash and loan that amount to the startup funds. And the investors are generally like angel investors, certain institutional investors. So these venture capitalists take a high risk because they're expecting certain high returns by investing into such new startup organization. What happened that since you all see that there is a startup trend going on, these startups, they get certain financing from these venture capitalists, and these venture capitalists get some equity right on that organization. So from that business, when it grows after for 5 years, after 7 years, or when it is sold to somebody else or somebody else acquire it, so whatever stake that they have in that organization, so though they are investing a small amount and they are expecting a very big return after their investment, because they are going to sell their stake to the one who's purchasing or acquiring that company. And this is how venture capital organizations work. So venture capital is one of the form of private equity, you can say. Private equity means when you are raising the finance from certain financial institutions, some institutional investors, and not raising the finance by publicly trading it. So in private equity, the investors which are there, they directly invest into the companies. So how either they buy out that company any private company or any public company which automatically delisted. So you understand what is buyout. Leverage is when the funds which are used to buy out any company are financed through or they are also borrowed, right? Venture capital we just discussed. And growth capital means when you do not want to change the control in that organization, but you want to expand or restructure. So such type of private equity is called as growth capital equity, in which the expansion is done without changing any control, so raising the funds from the existing shareholders. Now once the project has been funded, you have created a project plan, you have taken the funding, it's also important to review that how the project is actually performing, whether it is giving you the desired results, and whatever planning, the report that you have created, whether it is going as per your estimation. So project review and control can be divided into like project monitoring, project evaluation and project control. Project monitoring is more of a passive one because in this whatever has happened is actually analyzed that what is the stage, how it is working, whether it is working as per your estimation, as per your planning or not. So it is performed when the things have been done. There is no active involvement, or you can say it's not control. Monitoring involves only tracking that how work has been flowing. So project monitoring helps to evaluate that how the project is performing in terms of money, time, risk, quality, in any other areas of the project progress. In project evaluation, you evaluate or you can say you track. So one of the best way to evaluate the project is cost benefit analysis. So you all know about cost benefit analysis, in which the financing cost is taken into consideration and it is compared to the benefit out of that project. So if it results in a favorable return, that project is accepted. And how much the difference between the incremental cost and incremental gain is there, that is used to compare between the projects option available. Since nowadays the impact on environment is also one of the criteria which investors consider before investing into any project, there is a very social cost and benefit analysis used to evaluate any project. In social cost and benefit analysis, apart from the financing cost, the social effects, like if there is any project, how much harm it is creating to the pollution, steps it has taken, like whether it has used carbon points or not, the safety to the labor, any of the legal aspects. Now this cost is also taken into consideration before evaluating the benefit. So the net benefit is used by the investors to see the project viability. One more thing which is trending these days is to know the domestic resource cost. In this, it is compared that if what is the cost when we are importing that product is compared to what will be the cost if we manufacture that product domestically. So the resource cost is evaluated if that manufacturing is done in India instead of importing that product. So this will help the importer to know that how much competitive edge their country has, and it is beneficial that instead of importing, to itself manufacture it using Indian resources. So there is another benefit of domestic resource cost is it brings a favorable balance of payment. Since import will become less, so that will create benefit to the economy. So domestic resource cost is also one of the, you can say, a major criteria to evaluate a project in order to reduce the import or you can say dependence on the outsourced resources. Well, this is all there in project planning chapter, and this is also end of our syllabus. Very few hours you can complete all those 12 chapters in your syllabus. So in just these 43 lectures, if you have any doubt, just let me know. I try to clarify as much as possible in the easiest way. If you have any questions, just leave me a comment. I try to resolve your problems as soon as possible. All the best for exams and a very good life ahead. And as I say, keep smiling and thank you so much.